Hello, everyone, and welcome to Finance Friday. I'm Hard Money Jim, speaking from beautiful Jackson Hole, Wyoming, our summer quarters, but it's not summer yet out there, meaning it's still cold and slushy and with occasional snow showers. But there's a promise of summer out there. All the elk in the field out here behind my house in my backyard are on the move, heading back to higher ground into the nearby hills. And the bears are already out of hibernation and the birds are coming back and the prairie grass is turning green. So it's very fun to watch. But enough of the weather report. Today, I'd like to offer you some help in coping with this inflation that we're all experiencing. And I'd like to lay out some basic facts and principles about how you invest in a period of rising prices, which we are clearly in. And to do that, I want to do three things. First, I want to bring us up to date on inflation and the Fed's response to it. And we'll conclude after that little first part that that inflation is going to be here a while, that it's pretty well entrenched around the world. Then second, I want to take a look at how various kinds of investments, bonds, stocks, real estate, and so forth, have fared recently in reaction to the inflation numbers and the central bank's response to inflation. And we will see there that the results are mixed, ranging from pretty good to scary and sometimes downright ugly. And then I'll finish up today by discussing how to think about saving and investing your money under significant inflation. That is, when all or nearly all prices are rising rapidly, when the purchasing power of your money is noticeably declining right before your eyes. So, three parts to our discussion today. First, the current state of inflation. Second, a snapshot of recent investment performance. And third, some ideas about how to cope with the investment problem that we have before us, okay? The inflation problem. Now, two preliminary notes before we get into it. First, nothing we say here today should be taken as investment advice. Please do your own homework and consult your own advisors before investing any money in these very difficult markets. And second, keep in mind that as we speak, that I come from a particular point of interest, a particular point of view. And that is the point of view of analyzing money creation and its consequences. Now, I maintain that this inflation episode that we're in results from excessive money creation caused by government policy. Since about 2010 or so, we've had severe asset price inflation in the form of high stock and bond prices. Those prices, of course, are now in retreat, although they're still historically high. We've had high and rising house prices, and now finally in the last 9 months, we're having rapidly rising consumer prices. Everything from cars to gas to bacon and coffee is way up in price, as you have obviously noticed. Now, our monetary authorities, the Fed, the Treasury, the government, and so forth, believe rising consumer prices are the very definition of inflation. Now, I think that's wrong. A better definition of inflation is an undue increase in the money supply caused by the government. Rising consumer prices are just one major consequence of that money supply increase. I think you should define a phenomenon like inflation by referring to its cause and not just one of its consequences. And the failure of our monetary authorities to understand this is why they were surprised by rising consumer prices. They did not see this coming. The fact that consumer prices have completely surprised the Fed and the administration should tell us that they don't understand inflation as they claim to. So we have to be careful and defensive as we make our economic and investment decisions because our government does not know what it's doing. They have proved this time and time again. Okay, so let me share my screen here, and we'll jump into this. If I don't lose my mouse. All right. This quote up here by John Kenneth Galbraith is a really kind way to characterize our monetary mandarin's attitudes. We've had a period of stable consumer prices, and the Fed became indifferent to the risks of inflation, even though understanding it is their main job. So for those of you who can't see this, it says having the history of money reveals two highly reliable tendencies. Having recent experience of inflation, people cherish stable prices, and having long experience of stable prices, they become indifferent to the risk of inflation. Well, that describes the Fed very well. So, okay, so we have a problem of incompetent government, but your number one priority is not to solve the problem of poorly informed government meddling in the economic system. That's way too big a problem to solve here on this forum. So it doesn't do much good for us to complain and get mad about how dumb government's been. Our number one objective is regarding this ongoing war that our government has against the economy is to understand what they are doing so we and the people we care about can survive and hopefully prosper. That's why I'm so interested in money creation, which is the root of all inflation. And that is the basis for my discussion. We need to analyze, understand, then respond the best we can, and then learn to survive and prosper. That's our motivation. Okay, now with that long introduction, let's dive in. Part one, where are we now with inflation, specifically consumer price inflation and the Fed's response to it? New monthly CPI data came out Wednesday, a few days ago. The annual rate of increase in the consumer price index was 8.3%, slightly lower than the previous month's 8.5%. But the price increases within the index were broad-based, and this 8.3 number was higher than consensus expectations on Wall Street. So this number was interpreted by many as evidence that inflation is not going away anytime soon. And in The Economist and in the Financial Times, two good bellwethers of the financial markets, they back this up. Now here's a graph from The Economist using their proprietary measure of persistency and durability of high prices. And I show this not to endorse their method, but to point out to you that influential and sophisticated media think inflation is here to stay. Okay, so in response to this inflation, which is starting to sink into people more and more as a long-term trend, the U.S. Federal Reserve and other central banks, the only exception being the Bank of Japan, have reacted by raising short-term interest rates and promising to raise them a lot more in the next 12 to 18 months. And the central bankers, have also promised to stop creating more money by stopping or slowing their bond purchases, allowing their balance sheets to shrink as these bonds mature. Now, both of those actions, raising short-term rates and interest rates and stopping their bond purchases, are the two elements of what is known as tight monetary policy, where the combination of higher interest rates and a shrinking money supply, or at least a slower growing money supply, makes borrowing money harder for everyone. And that dampens overall spending in the economy, slows price increases, slows economic growth, and perhaps increases unemployment. But that's what they need to do to get prices down. The ongoing debate among professional investors has been, how much will the Fed tighten and how fast will they tighten? Based on investor polling that I saw by CNBC, professional investors have priced in 12, 25, 25 basis point rate hikes up to a range of 3 to 3.25% for 2022, and total of 14 rate hikes into 2023, meaning that we're looking to reach at least 3.5 to 3.75% in terms of short-term rates sometime next year. Now, if this changes, it's more likely to be on the upside, maybe to 4% or more. And some ex-Fed officials, like James Bullard, the former head of the New York Fed, are calling for much higher and faster rate hikes. So we'll see. We'll see. But anyway, as of today, the Fed balance sheet still has not shrunk, meaning they're still engaging in QE, in bond buying, even though a more modest rate. They say they're going to start shrinking the balance sheet in June, and the reaction in the financial markets will be interesting when we see that. So how far the Fed will go in reducing the balance sheet is the main question right now on Wall Street. Now, there's two currently different points, two basic different points of view on this in the market. First, there are those who believe that the Fed will not tighten enough to break the market, to really damage it. If that's true, a less aggressive policy might prop up stocks and bonds, even though they're down somewhat already, but it might prop them up. But it would also risk higher inflation for a longer time. And there's another camp. There's those who believe inflation is the priority for the Fed, and the Fed will bring it down at any cost. If that happens, that would risk a recession, or at worst, some kind of financial accident, possibly a major one, such as a market crash. And I'm not predicting that, but I am more in this group and in this line of thinking, with the caveat that I could be wrong, and I'll watch things and how they develop. But that's the two basic points of view out there. Now, on this first group, those who think the Fed will tighten and then back off, that group has now admitted that inflation is not transitory, but now they have kind of a new narrative. Some of these people on Wall Street believe the Fed's moving too fast and too far, and markets are already starting to break. I mean, they say, look, bonds are in a rout, and the yen has crashed, and a broad index of stocks like the Russell 2000 is down over 20%, and the NASDAQ is down, 27%. And on top of that, real GDP recently surprised everyone by coming in down, negative. So maybe something in the economy, they say, is breaking already. Shouldn't we therefore expect the Fed to back off from its stated intentions, which are to tighten aggressively? Well, that may be true, but I doubt it. And I want to tell you why I think so. I think we're facing prolonged inflation, and that will require aggressive action by the Fed. Okay, so I want to sort of make that case now briefly, if you'll bear with me. Next are a couple of charts that will require a little, let's say, heavy lifting on your part. So you'll need to take a sip of coffee and hopefully pay attention. Okay, this chart explains, I've showed it before, it explains the main reason why I think we will have prolonged inflation. And that prolonged inflation will require aggressive Fed action. This chart shows the relationship between the rate of increase in money supply per capita over a series of 5-year periods, and the rate of increase in consumer prices over the same 5-year period. So every point on the growth of money supply per capita, that's the blue line, is the percentage increase from 5 years before. And every point on the CPI, the orange line is the rate of increase in the CPI from 5 years before. So the idea is that as the money supply accumulates over time, it also affects price increases over time. Not always right away, but over time. So for example, the big peak in 1945, that big peak in the middle there, that says the money supply per capita increased 95% over its level that was in 1940. Now, notice that after each big surge in money supply per capita, that was accompanied by a rising consumer price level. Okay, now look over there to the right of that big peak. In 1980, the 5-year accumulation rate of money supply went to around 50% and was accompanied by a 5-year growth rate, high growth rate in the CPI as well. And now finally look at the right-hand side of the chart up to the 2000s, the very right-hand side, the very far right. In 2020, the 5-year rate of increase in the money supply was already high at sort of a 30-ish%. But then with the pandemic QE and all the free stimulus money that was sent to savers and spenders and everybody, the 5-year growth of money supply went to 63%, which is some of the highest numbers we've seen on this entire chart, which goes all the way back to 1875. So I will not be surprised if history repeats and delivers us a fairly prolonged episode of inflation. Okay, now that's the first reason I think the Fed will have to act aggressively. It's because I think inflation will be persistent and very tough to deal with. And the second reason, I think, is a little more heavy lifting for you. The second reason I think the Fed has to act aggressively is that the Fed's ability to ease is now restricted by rising consumer prices. Ever since 2009, the great financial crisis, the Fed has consistently lowered rates in response to market stresses. But during these times, we didn't have any inflation as the Fed defines it. Consumer prices were rising only 1% to 3% annually. So to explain this chart, the blue line is assets at the Fed, meaning that as they buy more bonds, do more QE, their assets grow. And the orange line is a broad index of stock prices, in this case, the Wilshire 5000. The green boxes show periods when the Fed was tightening, that is, raising short-term rates and stopping or slowing bond purchases. And that's when stocks were flat or down during these tight periods. And what you see is that when the market was down or growth was too slow, in the Fed's opinion, the Fed could increase QE. That's when the blue line goes up. And that would pump up stock prices. And remember from the CPI chart we showed at the beginning that consumer price inflation was not heavy at this time. It was not going up. It was only 1% to 3%. But now it's 8% plus. So things are different. So inflation restricts the Fed's option to maintain a loose monetary policy. Now, as further evidence that, excuse me, that the Fed is taking inflation very seriously, here's the opening line from Jay Powell's May 4th press conference, in which he announced a 0.5% increase in short-term interest rates. He says, "Before I go into the details of today's meeting, I'd like to take this opportunity to speak directly to the American people. Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it down. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses." Now, I think Powell here is clearly speaking to the people who suffer most from inflation. He's including that 40% of the population who live paycheck to paycheck with less than $1,000 in their savings account. So he is taking the politics of inflation and his reputation very seriously. He can no longer supply Wall Street with easy money because in doing that, he's hurting Main Street, causing inflation. So it seems likely to me the Fed will continue tightening until something breaks in the economy and we have a recession. But we're not there yet. So I expect that the Fed, will keep tightening until they see some significant break in inflation, and that will require more strain on the real economy than we currently have. Okay, to sum up this first part one. Inflation is entrenched. CPI may have peaked, but I believe it will remain persistently high. The Fed is committed to fighting the CPI raises by tighter money. And so for political and reputational reasons, they cannot stop until they break inflation. They're much less concerned about the level of the stock market or economic growth than they have been in the past 10 or 12 years. And, of the QE area, now they have to break inflation. All right, so can we, let's pause here for a few questions. I know that was a little bit of heavy lifting, but let's pause here for a few questions before we go into the next section. Daniel, do we have any question?
So we have super chat from Bonnie. Thank you, Bonnie. From Mark. And we have a question from Enric. What do you think of moving money into precious metals like monetary metals offers?
Let's delay that question to the end because I'm going to get into that a little bit. Okay. Will you accept that? Good. Because that's going to come up in about 20 minutes. Okay. Let's look at for part two, let's look at what the reaction in the investment markets has been, the reaction to the Fed's actions. And then after that, we'll get into the strategy points and the question from Mark. Okay. First, let's look at bonds worldwide. I think this chart says a lot. I hope you can see it well, but I'll describe it. I know it looks scary. It looks like kind of an evil jellyfish sea creature or something. But what this is the yearly total return of the Bloomberg Worldwide Aggregate Bond Index. And this index tracks about 18,000 bond issues worldwide in an index that was created in 1978. So we have 44 years of data, and each line going left to right is 1 year return of the index. As you follow each line left to right, each line's level represent a total return of the index up to that day. And when you get to the end of the line, each line on the right, you have the total return of the index for that year. Now, remember, the total return in bonds is interest accrued as well as price changes in the bond. And you'll also remember that when market interest rates rise, the price of existing bonds decline. So a decline in prices can sometimes overwhelm the payments of interest, causing a negative return in any given period, especially a 1 year period. Now that's rare, but it does happen. So notice the best 1 year return in the index, at the very top of the chart, was 1995, when worldwide bonds returned almost 20% that year. That's the stair-step pattern in the top. And it's stair-step because the prices and returns were only calculated monthly in that particular year. But in 1995, interest rates were much higher than they are today, and interest rates were also declining. So the combination of higher coupon interest and price appreciation gave you unusually high returns. A total return of 20%, like almost 20%, is a lot for bonds in 1 year. Now, by contrast, the worst 1 year return in bonds was 1999. That's toward the bottom of the chart, on the bottom right. And the total return in that year was minus 5.17% minus. And that was because interest rates rose during that year. Interest rates rose so much that the decline in bond prices overwhelmed the return that you received from coupon interest payments. So on a full year basis, you had a 5% loss. Okay, now with that as background, look at the dark black line on the lower left. Okay, that's the total return in bonds so far this year to date in 2022. This is minus 12%. That's interest earned minus the price decline due to rising prices. It's down 12%. This is worse than last time I showed this chart. We are 11 weeks into the year, and we have never seen a total loss in bonds of this magnitude. Okay. Now, interest rates, as you know, have been at a 4,000-year low, truly historic lows. And this means the return from interest payments is already very low because, the coupon payments are low. And it means that changes in bond prices due to rising rates can more easily overwhelm the return from interest payments than if interest rates were higher. And that's what's happened. That's what's happened. We've had extraordinary price movement that's overwhelmed the interest rate. So I've said before, this data sets off alarm bells for me. And I just want to quote an article in Bloomberg that came out yesterday to make the point. Quote, in most sell-offs of the bond market, investors can find a few safe havens. In previous market downturns, investors could seek to avoid losses by focusing on higher quality credits or avoiding rate-sensitive bonds. Neither option will work now, as a combination of rate hikes spurred by soaring inflation and concern about an economic slowdown are affecting all bonds. Now, the bond markets are huge. They're bigger than ever, and they're very complex and interwoven. So it's hard to tell what will happen as a result of this big shakeout in the bond market. But whatever does happen, this is a sign of stress in the financial markets that should make everyone sit up and take notice. It's like there's no place to hide. Okay. All right. So next, let's look at stocks. As we know, stocks went up a lot since the pandemic QE stimulus programs. But what about their reaction to the recent change of Fed policy? This chart gives you some color on how negatively the market has reacted to the Fed and its policies. The S&P 500 is down over 17% from the beginning of the year, which is also right near its all-time high. And that is the second worst start for any year ever. The worst was in 1932, which was the beginning of the Great Depression. So the stock and bond markets are in turmoil, and some of the percentage moves that we're seeing are kind of unprecedented. But people have very short memories of past market drops, and many are being surprised and caught off guard, and they're in some cases panicking or reacting too quick, saying, oh, what a great bond opportunity, let's buy the dip. That kind of short-term reaction is almost always the wrong thing to do. So let's take a breath and think about how to approach investing under conditions of inflation. We have to do something different under those conditions other than just buy an index of stocks and bonds. Now, here's a preview, as a preview to that. Here's a recent chart from Bloomberg, and it shows the performance of different assets since November 2021, when the stock market was reaching its kind of a 2-month peak, and inflation was becoming a reality to a lot of people. So that's why they picked that starting point. Industrial commodities, metals, fossil fuels, chemicals, and so forth, that's at the top. They're up big time, about 50%. Gold is flat to maybe up slightly. The NASDAQ tech stocks are down about 27%. And cryptocurrency assets and so forth are down in the minus 50%-ish range. And now, next, here are some just selected assets from 1 year ago. Now, they're different from what I've showed because 1 year ago, the market was rising, and then it peaked in November to January, and then it has fallen off precipitously. So this is a 1-year snapshot, included just to let you know another view of where the markets are right now, because not all of you follow this closely. In this view, house prices and oil are the big winners. Houses are up, house prices are up, but house price increases have slowed a bit recently. Mortgage rates have risen a lot, and higher prices are starting to dampen buyer demand, it looks like. Now, energy has performed very well and continues to do so, and gold sort of held its own, as I said. Although gold has not changed much in terms of its dollar price change, but it's also near an all-time high when priced in other currencies, which have declined strongly against the dollar. So that might help explain why gold has not done a little better than you would expect. I mean, it's been kind of overwhelmed by a rapidly rising dollar. All right. And the cryptocurrency sell-off continues. This is just from the last, this is from the beginning of the year. Where does this start? I can't remember exactly when that started, but anyway, the peak was at about 65,000 for Bitcoin. This is a Bitcoin chart. And you can see it has declined by at least 50%. So that's a brief look at the current state of the investment landscape. And let's now move on to part 3, which would be kind of a view of 10,000 feet on how, just a general strategy. How do you invest under persistently inflationary conditions? If you buy my theory that inflation is here to stay for a few years at least, you need kind of a strategy to invest in an inflationary atmosphere. And so to start off with, I want to commend to you a particular investment advisor, a writer, and someone I respect a lot. I said a few weeks ago that I would start mentioning the sources that I use and the people I read. So I think this is a good place to start. This lady's name is Lynn Alden, A-L-D-E-N. She's fairly well known in professional investment circles. She's not a household name, only because she's all business and doesn't try to be flashy or kind of be out there in the public eye. She's definitely not a loudmouth Jim Cramer type. She's honest and interested in getting her analysis right rather than becoming famous. She's brainy, she's highly analytical, but she's also readable, understandable. It's very clear that she favors free markets, but she knows we don't operate under free markets. So she tailors her analysis accordingly. She tries to keep strong emotions out of her work. And I think that's admirable. And it's hard to do if you're a free market advocate like me and probably like you. You have to put your sense of government injustice out of your mind when you're investing. You have not to rage. You have to put on a different hat when you are investing in a mixed economy that's dominated by government mistakes. And Lynn Alden does that well. Now, some of Lynn's information is free. You can find it all at lynnalden.com. But I think you should consider paying to subscribe. Her basic newsletter is free and it is valuable. Her premium level service is only $200 a year. I can tell you, having been in this business for many years, that her research is of good, high institutional quality. She has a breadth of coverage, including stocks, bonds, real estate, precious metals, and even the major cryptocurrencies. She's not very visible on the major media networks. You don't see her much on CNBC or Fox or Bloomberg, but she is far more visible on the more serious and analytical blogs and videos. I stress now, I am talking her up because I respect her work and I use it. I do not personally know Lynn Alden. I have no financial relationship with her other than I'm a subscriber, okay? Now, she recently wrote a very good piece called Investing During Stagflation 101, where she laid out some very good basic concepts for investing in the current environment. So I want to take the rest of our time today, checking the time, we're good on time. I want to take the rest of the time today to go over part of her article and talk about some of the main asset classes that you can invest in: stocks, bonds, cash, real estate, and so forth. So what we're going to talk about next is the various categories of assets in which you can put your money. And I'm just going to do a basic review, the basic characteristics of each one, and to help you, just call this your first step in forming a coherent investment strategy for inflation. Okay? So first, let's talk about cash, by which I mean bank accounts, money market funds, short-term CDs, and very short-term bonds like T-bills. You can hold all these forms of cash or near cash in your brokerage account. Cash is somewhat of a passive investment, but you're not being a chicken if you hold cash. It's an important investment decision. I mean, Warren Buffett once said, investing is like sex. Sometimes it's better to just abstain. And you abstained from severe risk in investing by being in cash. Okay, so now on the positive side, you will not lose money, at least not in terms of nominal dollars. Most important, you'll have dry powder available during volatile times. You'll be ready to take advantage of a bargain if one comes along, and in volatile times they do. The flexibility or optionality of cash is thus very valuable in volatile markets. Now, on the negative side, cash is just a fact, generally loses purchasing power under inflation. Short-term money market rates sometimes offset inflation, but they're usually lower than the rate of price increases. So if money market rates rise with inflation, your return on cash-like investments will offset the loss of your purchasing power to some degree, but not entirely. So for example, maybe you'll get a 3% money market rate on your cash when prices are increasing by 6%. Losing, but not as bad as if you were just holding a dollar bill, okay? Sometimes you'll do better. I remember back in 1981, money market funds were paying 20% back then. And in 1984, when I first entered the investment business professionally, money market funds were paying around 10%. And at that time, those rates were higher than the CPI inflation rate because everybody was sure inflation was going even higher. So to compensate for that, short-term rates were very high. And the bottom line is for cash, it's a fairly safe haven under inflation, but you will not grow your nest egg. Okay? All right, next let's talk about bonds. A bond is a promise to pay a certain amount of money in the future. You can buy bonds in your brokerage account, or you can buy into a fund of bonds and hold that in your account. On the positive side, if you hold bonds till maturity, until they mature and pay back all your principal, you will get your money back, assuming that the borrower, the bond issuer, is a high quality credit. And in that sense, with bonds, you can buy and forget. And under inflation, short-term bonds might be okay. For example, right now you can get 2.5% or so, maybe a little better, on a 2-year treasury bond. But on the negative side, and this is the big problem, is the loss of purchasing power. If rates are rising, you'll take a loss on the market price of longer-term bonds. And unlike cash, you might have to take a market price loss in order to take the money out of your bonds and reinvest in something better. Okay, so in other words, if you do need to sell, you could lose money, as we've seen on the jellyfish chart. Now, longer-term bonds are especially risky under inflation, and they're especially risky when existing interest rates are historically low, like they are today, and rising like they are today. Now, the interest rate moves could reverse any time, which would, prove me a liar temporarily, but that's just the condition we're in right now. Also, you should know that the quality of bonds may vary, and low quality suffers most in bad times. If you want to invest in the higher yielding, lower quality bonds, you need to understand bond ratings or buy a managed fund. Okay? Now, stocks. Stocks are a mixed bag under inflation. Don't think that stocks are automatically a great hedge against inflation. Many stocks don't fare much better than bonds, but some can do very well. You might think stocks that shares in general are a good hedge against inflation because a company's revenue is generally rising when the companies have to raise prices. So you think, oh yeah, they'll stay up with inflation. But you have to remember their expenses are also rising too, and it's hard to know whether their revenues or costs will rise first or faster. Okay, so it's also true that as bond yields rise, that puts valuation pressure on high-priced stocks. On the positive side, though, some stocks can do very well. And this could be a complex subject, but I'm just going to mention a few things. You should look for low variable cost, high fixed cost companies with pricing power. For example, retail paper producers historically can raise their prices to cover costs. Oil companies can often do well. In general, you're looking for makers of price inelastic products, meaning people will still buy the product, even if that product price rises considerably. Oil is like that. It's very price inelastic. People have to have it. And you would like to avoid companies with high capital investment replacement costs. You would like a business that scales up well with relatively little investment. In other words, you can look for companies that have pricing power. They're able to raise their prices as costs rise. And some companies that might work well are mineral royalty companies, software companies, investment brokers, and trading exchanges, to name a few sort of classics in that asset-light category. Now, on the negative side for stocks, a broad index, say the S&P 500, might disappoint you. You have to be selective. For example, if you're going to invest in mining stocks, precious metals like gold or strategic metals like uranium, you're going to need some expert advice. They are not easy to follow, and you can't invest blindly. Speculative stocks that depend on rapid growth may not perform well because higher interest rates make growing companies harder to finance. And taxes on inflated profits can eat into real company returns. So inflation is definitely not to buy the no profit stocks, those that have small or no profits and are hoping for market lightning to strike years from now, and therefore bid up the price today. Rising interest rates and declining liquidity in the market will kill some of those stocks, just like it's going to kill the zombie companies that we talked about a few weeks ago. So stocks are a mixed bag. Be careful. Now, real estate generally tends to do better under inflation than stocks and bonds. Speaking of houses, that would especially be true if you have a house with a fixed rate mortgage attached to it. On the positive side, real estate values usually rise with inflation. Fixed rate mortgage can help as rates rise because you're taking advantage of appreciation on the asset side, and you're limiting your cost with a fixed rate mortgage on the liability side. So, for example, your house price typically adjusts upward with inflation over time, but it's true that a given house price might stagnate sideways for a while, but usually they will hold their real value over a long period of time. Real estate is, on the negative side, real estate is not as liquid as stocks if you need to sell. Real estate is not homogeneous. Real estate is a very local market. It depends on local buyers and local sellers, as opposed to stocks and bonds, where the buyers and sellers could be anywhere. And shifts in demand patterns, like geographic and demographic shift patterns, may hurt some markets and help others. So, for example, there's a decline in retail stores and office buildings, so you expect that kind of commercial property to take a hit. On the other hand, single family homes are getting a big shot in the arm post pandemic. And also there's a geographical migration to, the South and the West from the big city centers. And that can help those markets. All right, industrial commodities. Now, this is a category you normally don't think of, but they are big winners in inflationary environments. Almost by definition, if inflation is high, it means commodity prices are rising. And often during inflationary environments, commodities are undersupplied, like oil is now. And it often takes on years to bring on new supply. And that weighs on real economic growth, contributes to the stagflationary situation, but it keeps commodity producers in high demand. Now, commodities, though, can be very volatile as they move up with sharp pullbacks. And that's true even in environments that are beneficial for commodities. So in general, the positive is commodities do well under rising prices. The cons are you have limited options. Mining stocks, for example, are risky. I mentioned those. You can buy commodities through the electronic trading funds, the ETFs, but they are expensive. These funds are expensive to operate. So fees and costs can eat into your return. And as I said, commodities can be volatile with sharp pullbacks, even in generally upward environments. And that means you have to have some nerve to stay with them during those times. Okay, so now precious metals. Generally, gold and silver hold up well in a recession, in an inflationary recession. They have an eventual, not perfect, but an eventual correlation with inflation, just not necessarily at the exact moment the high inflation is peaking, unlike industrial commodities that tend to be more correlated with consumer inflation. But gold in particular tends to do well under stagflation, where economic growth is decelerating, but inflation is still pretty high. And it also tends to hold up well in outright disinflation environments, at least compared to equities. Okay, the general pros of precious metals are they're the money of last resort, and they have a solid demand across all time and all geography. They can be volatile, but not as much as a lot of other investments. Now, the negatives are that there are storage costs in holding them, or you can put them in your safe, and typically there's no dividend. Okay, now, I am not going to comment on cryptocurrencies much unless you want to ask a question about them. Despite this cartoon, which makes fun of them a little bit, I'm agnostic on cryptocurrencies as investment vehicles. I do have an opinion on their use as money, but I'll take that if you. I'll take a question on it if you want to ask. We're running a bit long today, so I'm going to wrap up now. Do take a look at the Lynn Alden article. There's a great article on Turkey as a teaching, as an economy that can teach you some things. Okay, so we've covered a lot today. Let me get back to the question about monetary metals. Daniel, would you repeat that question, please?
Yes, so the question is, what do you think of moving money into precious metals like monetary metals offers?
Are you speaking, I assume when you say monetary metals generically, I am in favor of owning them. I think everyone should own some gold and some silver. I do myself. I think it's always good to have it as an insurance policy for monetary breakdown. It's the monetary metals are the only monetary asset that I know of that is completely distinct and separate from the financial system. And that's very important. It's the only money that I know of that is not someone else's liability. We've talked a lot about how money is, on this forum, how money is created. It's created by a computer stroke. It's the liability of a bank or the liability of a Fed. And if they don't want to make good on it, they often have the power not to. It's not true with gold. You own gold, it's there. You have it, you own it. Now, there's other issues with owning gold, but it is separate from the financial system. Now, I think the questioner might be asking about monetary metals and company as well. And so I need to address that. Full disclosure here, I was not going to mention it today, but I am on the board of directors of a company called Monetary Metals and Company, Monetary Metals and Co. You can find us on the internet. And this company's been in existence for about 5 years. I want to have its founder, Keith Weiner, on here for an interview someday soon. But we pay interest on gold in gold. And Keith has found a way to do that very effectively and conservatively. You don't have to go into the futures markets or anything like that. And I'm not going to tout it any more than that because that would be inappropriate on this forum. But you can check it out if you want to. I am involved in it, and I do. I'm not a paid board member, but I do own shares in the company. So I am an investor in the company. So that's all I'll say about Monetary Metals and Company. Okay. Any other questions here, Daniel, to wrap up?
We have a super chat from Jonathan, thank you, and one from Free Trade. He gave us actually 100 Swedish krona, which is, I believe, like $10. And he says, I appreciate these shows, value for value.
Oh, well, great. I love to hear that. Thank you very much. And thank you for supporting ARC UK. I do want to point out in closing, here's my information page. I recently republished an interview with George Reisman, the great George Reisman, on my Substack forum. George is, in my opinion, well, I'll just say, in my opinion, George Reisman is the greatest living economist and the foremost spokesman for capitalism. And I expect that this interview is going to be reprinted in some other. It was originally in the Objective Standard about a year ago, a little over a year ago. And now that under agreement, I can reprint it. It belonged to the Objective Standard for a while, but now I can reprint it and recirculate it, and I'm doing that. So please take a look. It's a delightful interview. It's all about George's relationship with Ayn Rand and Ludwig von Mises, and there's even a really good little story about how knowledge of economics affects the course of history. A really good little sort of anecdote in there. All right, so with that, thank you very much. And as usual, be careful out there, and we'll see you again in about 2 weeks. I'm off next weekend to watch my son graduate college, but I'll be back 2 weeks from today. So thanks a lot, and bye-bye.